The other one that we're talking about is Patanjali Foods. In focus, as the government has increased basic import duty on edible oils by 20%. A sentiment negative for the sector, but is it really so? We have Sanjeev Asthana, CEO of Patanjali Foods, with us in the studio. Thank you, Sanjeev, for joining us in the studio. We've been talking distantly for a while right now, but this is a topic that needs to be addressed, right? 20% increase in import duty for refined oils and refined edible oils, etc. Just your thoughts on one, after this increase, what does it take your basic procurement price to? And would that have any impact on margins? Would you be able to pass it on?
No, so there are two parts. One is that this was a very critical requirement which the government has fulfilled. Two bits which were impacting it. One was that the oilseed prices were running way below the minimum support price declared by the government. And this was causing enormous amount of stress to the farmers of soybeans and mustard. So government had to do. And second is the differential between the crude oil and the refined oil was very minimal, which was hurting the industry as well. So in terms of the step taken by the government is very timely, and I think it's a very welcome step for the industry. The issue which still needs to be resolved is the differential between the crude oil prices and the refined oil prices, which is basically supporting the overseas refiners, which can continue to sort of find homes into India. And Indian refineries will have to struggle to really make the margins meet. So there's a one-time inventory gain, which will be offset by part of the gains because the advanced sales what have been done. You have to buy a higher sort of priced oil.
So what happens to players like you? Because you are, I presume, importing a lot of these as well. With the import duty having increased 20%, does your cost of procurement of these products increases, and could we see an impact on your margins?
No, it does. I think there are two sides. So one is, as I mentioned, there's a one-time sort of, some value, on the profitability which will increase. The larger issue here is that, for the sector itself is positive. For the oilseeds as a sector which is going to be on the growth path, this is positive. And the third piece is that, calibrating the prices to reach the levels at what's internationally are required. So that's very important. So I would say that overall a very positive step.
Just another word on the, oil import duty and the impact. I remember earlier conversations a couple of months back where you yourself are getting into, palm oil cultivation in a very big way, right? So what is the target? I mean, how much would you want it to be captive? What is it right now? And what are the timelines on that whole project?
No, so currently we have got about 75,000 hectares which is under cultivation, of which nearly 70% is already yielding. So we make a serious amount of money. It's almost an assured EBITDA margin of between 16 and 18% that we get. We are targeting 500,000 hectares over 5 years. The target geographies being south of India, Andhra, Telangana, Karnataka, and the northeastern part of the country. So it's a large project, very positive in terms of the future sort of EBITDA additions that we can make to the business. And it's almost like an annuity gains that we'll be able to do that.
And how much of your own demand or requirement is being met through your own cultivation?
So today we do about 10% of what we do. So we produce about 110,000 tons of crude palm oil from that. This, in fullness of time, when we do entire 500,000 hectares, will go to close to about 500,000 hectares, 500,000 tons. And this will be about 60% of what we'll require, because by that time our imports will also continue to increase. So very positive, as a project that we're taking, and of course very helpful for the country as well, in terms of reducing the dependency on imports.
So with all things being positive, the question that one begets asking is, why is it that the promoters sold about 3% stake in the company a couple of days ago? GQG bought that stake. They already held about 3% stake. So what's the plan with GQG? Are they looking to buy more stake? And the promoter stake selling?
So I think there are two sides. One is that the global investors have reposed a lot of faith. And this validation of, what we just did, a block deal, the promoters did, it is very positive in terms of the global marquee investors have tended to repose a lot of faith in the Indian consumer story, Patanjali in particular. So that's something that we feel very happy about. Longer term plan is that, we will continue to sort of build a stronger sort of platform. Integration of HPC business shouldn't take too much of time. I think we're just waiting final regulatory approval. This should happen pretty much within this month. And from the next quarter, we'll start inducting the HPC business into the fold of the company. So very positive for the company, good for the promoters, and I would imagine very good for the sector as well. That's a lot more.
Will they sell more?
Yeah, you didn't answer the question.
I don't
if you had any conversation on why they sold, I mean, it's 2.7%, not too much stake sale. I guess even after the stake sale, the level is 70% promoter holding. But was there any conversation?
No, of course. I think largely the very clear cut that promoters have largely divested all their profit-making businesses into this entity, the listed entity.
Got it.
They need to clear their own debts, and it's a very logical way. So, the source of income to pay off the debt, I think this is one way to do that.
What is the debt on their books right now, and does it get cleared with this 3% stake sale?
So most of it will get cleared. There's a partial sort of debt which will remain. That will continue that. So there are no timelines. There's no plan to kind of divest any further equity.
Mr. Asthana, would you look at demerging? When will you look at demerging the oil and the non-oil businesses within the fold, your fold?
So this question gets asked very frequently. So our plan is not to demerge at all. So these are very good businesses. So for example, oil palm oil is vertically integrated, which integrates itself into the branded side of the business. So there's no such sort of plan on the cards right now. And we will build up a strong company, which is diversified.
Bankers have come to you, how it'll mean value accretion and this and I mean, you know all of this. The essential point is one is a very low margin business, the other is a much higher margin business, and that's where the argument stems from.
No, you're right. I think this gets discussed very often, and I think this is something that we've thought this over. And the belief is right now that demerging anything would not be a sensible step for the company to take.
That's as of now.
Not as of now, for the future as well. For the moment.
So no plans at all? I mean,
none at all.
Nothing,
none at all. None at all. It's not on the table.
How's the non-oil business doing? I mean, could you give us a real sense across segments for you?
So non-oil business is very strong. Last year we did almost 10,000 crores of revenue, which is 30% of the company's overall revenue. Target is to, over next 5 years, to take it to 50-50 between the edible oils and go to the double-digit EBITDA. And perhaps do better. HPC portfolio will add a lot of heft to what we offer. Yeah. And all the categories are going fairly strong. So foods, FMCG side is growing at 10%. HPC, the target is that we'll grow at 15%. The edible oil category is growing at between 3 to 4%, which is where we want it to stay as well. And so overall, we are feeling pretty positive. So on all the parameters in terms of return on equity, the overall absolute profits that we are able to generate, return for the stakeholders, the overall aggregation, it's a good story.
So tell us one thing. I mean, you did, in FY24, you did revenues of just under 32,000 crores. Margins ballpark around 5%. You're talking about all these other engines firing up, HPC, building margins over there, the plantation business being more accretive for the EBITDA. So FY25 and more importantly, say FY26, once the integration is done, what are we talking about in terms of top line growth and lifting the margin profile itself of the listed blended entity Patanjali Foods?
Our target is to keep adding 1 percentage point to 1.5% every year, financial year, to go towards 10% double-digit EBITDA.
Got it.
So the story, the sort of the trend line that we want to make sure that we get closer to 6.5% next year and continue pushing thereafter. And we feel pretty confident with the FMCG businesses doing well. Oil from the last 5 quarters of sort of disturbed situation. Last 2 quarters we've seen a positive sort of play. Markets have stabilized. So overall we feel pretty confident of the projection.
So 6.5% this year, right, on the margin?
This year we'll have a lesser sort of window available now with the HPC business coming in. So, but we'll certainly add to the EBITDA of last year for sure.
And just a here and now question itself. You said by the end of this month the HPC business comes in. So this year 1,500 crore in terms of top line from that HPC business on the cards. Can one look at it? Because last year you did close to 2,800 crores. Assuming you're doing 3,000 crores, half of the year comes in. That's not out of whack, right? That expectation?
So that should be pretty much on the cards, yeah.
And about the oil business itself, it's now on a favorable cycle for you. Last quarter, you did closer to 200 crore EBITDA. So 200 crore EBIT. 250 crore EBIT for the next few quarters, that's on the cards as well?
It should be very much feasible, yes.
All
Looks
right.
very likely.
And promoters do not pare their stake beyond that 65% mark for the near future.
69% mark.
69% mark. We get that. Thank you so much for joining us in our studio and
Thank you.
Giving us an outlook on the business, the promoters' plans, and the way forward for your oil and non-oil businesses as well. A pleasure speaking with you. So that was the management of Patanjali Foods indicating that they will increase their margins by about 100 to 150 basis points annually. This year, 1,500 crore revenue from the HPC business. For the next few quarters, 250 crores in terms of operating profit coming in from their oil business as well. Promoters not looking to sell their stake beyond that 69% right now.